Hello, everyone. Welcome to the stock specific class here for Thursday, February the 4th. Real quick look at the direction alerts. With the market moving up a little bit this week, we're moving back into the buy range on the momentum, still in the trending range on breadth, but back into the complacency area on sentiment. Again, that's it's good that we're moving in that direction. That's a bullish sign that we're moving that direction. We're not showing any extremes, so we're not anticipating any reversals. The buy sell ratios have started to widen again with the buys, a lot of stocks going back to buys, and so that's good, but it's not an extreme yet. Sentiment has moved up a little bit, but again, not near the extreme. Real quickly on the chart. Now, what I talked about a little bit on Tuesday was I was concerned. Let's switch this over to candlesticks here. I was concerned with the we had the kind of that big rally day, but we had very light volume, and we've been declining in volume all week, and it looks like with only a couple hours to go that this is going to be the lightest volume day of the week. And so that's not a good sign when you're rallying up, especially after a drop like we had last week. Now at this point though, as far as we've come up, usually when you're retracing a move and you're going to turn around and go lower, usually it's just a partial retracement. 50% or so is usually the general guideline. Stocks will tend to retrace about 50% of their moves. So now that we're right up here about to break out, the chances are we're likely to break out. It could just be that the volume is going to show up when the market finally breaks out. Part of the problem with getting a drop like we did last week is that people don't trust the rally when it comes back because they got burned a little bit maybe, and especially all those Reddit traders, the Gamestop traders, got burned pretty bad this last week with it coming all the way back down. And so I can understand how the volume is a little bit lighter on the way back up, but you always have to worry about that whenever you rally on light volume. That if things do roll over, it could drop back down, and I probably won't be a confident buyer until I can see that we break out and the chance of that next move lower significantly gets reduced. So that's what we'll be looking at. I thought we'd get one or the other by today's update. The way things were looking, I thought we'd either be moving lower or we'd be breaking out already. But and we are on some of the indexes. The Dow is still a little ways away from its previous high right there, but the Qs went right up to, they opened and moved right up to that previous high. I think it was still slightly lower than it. Had a little bit of a bearish reversal candle, but that's reversing back again today, so that should be pretty close to breaking out. And then the IWM did break out today, and since the IWM has been kind of leading the way, it's been one of the leading indexes, the leaders, the small caps through most of this run. That's a good sign. That's a good sign that the IWM is breaking out. Another thing too is the VIX came way down as well, and we had some modest, like yesterday we had basically a flat day, and the S&P 500 is barely up, but the VIX dropped down significantly. Now, let me take the volume bars off here so you can see it dropped down significantly yesterday, and then it's down again today. So we're right back down to where we were a couple weeks ago, and that's a good bullish sign that the volatility has come back. If you remember last week when we had that big volume spike on the drop, you might remember I said, normally when I see that, I get really concerned that we're going to get a really big sell-off, that we're just getting started with the selling. But I made the comment that it was kind of a gut instinct, that it just felt different, and it just felt like it was the fear was really geared towards the uncertainty of what those Reddit traders were doing and what impact they could have on the whole market. or other stocks. And sometimes if it's based on, if the fear is based on something that could be very temporary, you could get a spike and then it could come right back, and that's what happened. And I wish I could explain. Sometimes in charts, I've been doing this so long that sometimes I'll get these gut feelings on things, and I can't explain why. I can't explain why I'm feeling that way. And the reason I think is because there's been so many inputs over the years, so many things I've seen over the years, that it gets somewhere in my brain, but I don't know. I don't know why I'm getting that gut feeling that something should happen, but something I've observed in the past is probably kind of warning me that I've seen that before, or I've seen that happen before, and I just can't I can't remember the specific instance or example. Now, to be fair, I've had gut feelings before that have been totally wrong as well. So I don't want to, just because I say I have a gut feeling in these updates, don't assume that it's absolute. But anyway, and to be honest with you, remember earlier this week I was still feeling kind of bearish on the market, that we could roll over there with that light volume on the rally. So I still didn't really trust that we were going to come right back down from the VIX, spiking up last week. But that's what's happening. Like I said, it's a bullish sign, and really what we need now is the market to break out above that recent high to a new all-time high here. And I really think that'll attract the buyers when that happens, or at least more of the buyers. All right, let's get into some individual stocks here. On the retail sector, I had to laugh because as soon as I pulled this up today, at the top of the list is Gamestop, and that's kind of an anomaly, and that's why we like to look at the charts and not always just go off of the strength rank. We can understand why it has a high strength rank. It shot up. We can look at GameStop. There was the incredible push higher where it went from about a $13 or $14 stock to $500. It's come all the way back down, and this is over just 2 weeks or a couple weeks, 3 weeks. About 3 weeks. It's now at $60. I recommend staying away from this thing because there could be further decline, and with all the damage that's been done, even if it does start to rally again, I would imagine that it would be more tepid and more gradual. Probably is ready for an extended sideways move as uncommitted traders move on to something else. It's just not something I'd be messing around with, especially with the volatility it's shown over the last few weeks there. But if we go further down the list, I do like, I'd still like the FVRR. I've covered that for a couple of updates, so I'm not going to spend more time on that one. That's still wait for it to go to that buy signal. And it's getting close, but I still like that one. But this one below it, At Home Group, HOME is the ticker symbol. It's a 94 strength rank, but I like the pattern. Let me switch this back to signals here. And I'm going to go out to a 1-year chart real quick because I can show you. So it broke out. Here was the previous breakout area right here. It broke out of that recently, and then it came back, and it looks like it's retesting that breakout. Now, remember, when you get these bowl-shaped moves and they break out, what's the rule of thumb? I go over it all the time. You can take the distance from the top of that kind of bowl-shaped move to the bottom, project that distance upward when it breaks out, and that's kind of a target area of where it could get to. Now, as I say many times, this is a good example. Doesn't mean it's going to go straight there. It broke out, looks like it's coming back and retesting the breakout. It'll probably just start stair-stepping its way up to that area, but it looks like it could be working its way up there. Now, you do want to make sure this holds right in through here. Sometimes it can dip a little bit back below that breakout area and come higher. But that's why I think it's a good idea to wait for the confirmation on this, wait for it to go back to the buy signal. It's real close. If it starts moving back up from here, if you had a decent up day, we'd go right back to a buy signal. It's because it's so close to going back to a buy signal. And if the market breaks out, it wouldn't surprise me if this kind of moved up along with it, and you might get that buy signal when the S&P breaks out. Another one in that group, again, a little bit lower strength rank. The retail sector here is Lumber Liquidators, LL is the ticker symbol, 93 strength rank. I've liked the stock for a while, and I liked it when it had this little run up through here. And it seems to have had a deeper correction, just recently had a sell signal, but I like the pattern here. This looks like a kind of a textbook ABC correction. Again, notice how this is typically how stocks will tend to pull back, although it didn't really do it on this run up. It kind of just had a quick drop and then took off again. But you have that initial move down, then you try to get a bounce right here where it tries to rally. It could look a little bit more choppy, more sideways. That's your wave B. And then you had a sharper move down for wave C. And it looks like it's starting to, well, another thing here you could add in is that not only does it look like it pulled back in that ABC, but if you look at this run up, this last run up right here, it looks like it's retraced about half of that move. And if you remember in that retracements class I did several weeks ago now, stocks will I mentioned that stocks will tend to retrace about 50% of their moves. So this is definitely the area where you would, if this is a correction and the trend's going to continue, this is the area where you would expect it to that correction to end in that 50% retracement area. Now this one has a little ways to go back to that buy signal. In fact, you can see it just barely went to hold. But I think this is one you kind of keep an eye on. Put it in your watch list, keep an eye on it, and it, that would be good confirmation by the time it got back to that buy signal that it looked like the uptrend is back to being underway. At least that's what we're assuming here based on the chart pattern there. But that one looks pretty good. And that strength rank will increase, and it could be up, closer to 96, 97 or so by the time that goes back to a buy signal. So we'll keep an eye on that one. All right, let's go into computer and technology. And there's only really one I like in this one. Oh, well, except I did cover Blink Charging Company, BLNK, on Tuesday, so I didn't. And I've covered Franklin Wireless a number of times as well. I still like both of those. I'm going to drop down, though, to a little ways down to AEYE, Audio I, 95 strength rank. This one's been consolidating for quite a while here, a number of weeks here. Recently had a sell signal and then big move up today that popped it up even into a buy signal even. Now, that you could say, well, man, I don't want to chase that, especially since we're almost at the previous high right here. But again, this is one where if we back out, you had this. Here is the breakout area. It looks like it's pulled back to that breakout area. And whether you're using the top and bottom of this last correction projected upward, or you just take this correction right here, if we break out, it should go up about the same distance as the width of that, or the yeah, the distance between the top and the bottom of this correction right here, projected from the breakout area there, that gives you about a minimum target of how far it should go if that trend continues. So, so that there's definitely some potential there that this could move higher. And if you look at the volume today, so you're getting that breakout move, and it looks like the volume is going to be higher than the average. Now, I wouldn't say it's significantly higher yet because it's not going to be at these levels right here. But you can see when this one started to take off, you had a higher than average volume day right here, and then you start to see the significant increase of volume. And that would probably happen if this thing does break out, that you'd see, those volume spikes, or it would be great if you saw it break out on higher volume. That'd be a really good sign that this thing was taking off. But I always like when you have these kind of consolidation periods, and then you get a real solid day, up day. A lot of times it's signaling the start of a move. Now, when it's this big of a move like we've had today, sometimes it can consolidate from that big move. So you get the big pop move, and then it might pull back a little bit or consolidate a little bit for a few more days and then take off again. But again, it depends on the time frame of if you're looking at a real short-term trade on this, then you just, or whether you're expecting a longer term, you might get a little bit of a pullback off of a day like today, but that's usually a sign that something's kicking off, and that this thing could run for a few more days, or a few more weeks. All right, let's move on to industrial products. And under this one, I like Plug Power right here, PLUG, 99 strength rank. And it just went to a buy signal today. But I like it's been kind of consolidating like through here. Now it was kind of consolidating through here and kind of looked like it was breaking out a little bit, and it's kind of pulled back, went to a hold signal. But now it's come back to a buy. And again, this is another one that if the market breaks out right here, I could see this one make another run. Maybe not as steep as this one. This is a pretty sharp move it made back here. But there's still a lot of momentum with the stock and in the whole sector, or in the whole alternative energy type group. And that looks like it could be starting another run there. If you look at despite that sharp move up, with the sideways move it's made, it's come back off of the extreme level right there, and so it could still run for a little while. And I like this both as a trade, because if it breaks out right here, again, rule of thumb, you could take the top and bottom of the range it's in, project that from the breakout area, get a nice little run for a few weeks here. But I also like this longer term with the new administration. A lot of these alternative energy companies are going to probably do pretty well for the next couple of years. All right, lastly, let's look under basic materials. And I liked this one right here, Lithium America Corporation, LIC, 95 strength rank. But again, it kind of has that ABC pullback. It still could possibly come back down and a little bit further to retest that breakout area there. But and that's why we wait for it to go back to the buy signal. But I like the pattern. I like the pullback right there, and I think this is probably getting pretty close to making another run. A little ways away from going back to that buy signal. again, as I said earlier, if the market breaks out, you can see a lot of these stocks start taking off again. All right. I forgot to mention at the beginning of the update what the training was going to be on today, so I try to do that so that those that can, so people can decide whether they want to wait around for it or not when I start getting into it. But we're going to continue with the discussion on Elliott wave analysis, and what we're going to talk about today are the Elliott wave rules. On Tuesday, we talked about the waves, and we talked about the fractals and all that kind of stuff. These waves follow a set of rules, and these rules are going to be very important because, as I mentioned at the close of the last class, that without these rules, you could basically come up with whatever wave count you wanted to. You could, if you were bullish on the stock, you could find a wave count that would match or confirm your bullishness on that stock. If you're bearish on a stock, you could find a wave count that would make you feel like you're right in being bearish on that stock. And obviously, that's not going to do anybody any good if it's already kind of confirming what you already believe. You got to have something that tells you you're wrong or you're likely wrong, and that's what these wave rules will do. Now I'm going to read through them real quick, the 4 rules. Another thing too is these are although they're rules, there are cases whenever you're dealing with the market, you can't get too caught up with exactness because nothing moves in an exact fashion in the market, and so there are rare cases where you see a trend that clearly has the waves, but it may slightly violate one of the rules. But the only way that usually it's looking back in hindsight where you're like, man, those are the waves. It slightly broke a rule here, but it still looks like that was the wave count. There are situations like that, but the key is that usually they're rare. So if you're seeing rules getting broken all the time, and you're justifying that and still going ahead with your trade, it's probably more has to do with your bias than the rules, being broken on this rare occasion. It just doesn't happen very often. So the reason why I'm saying that is because I do want you to be aware that there are going to be times where it did slightly maybe break a rule, but was still probably the proper count. But I also want to emphasize that if it's happening a lot, then it has more to do with your analysis. Your analysis is probably wrong. And then there's also the last rule. The 3 main rules are the ones that are pretty strict. They're rarely going to be broken. The 4th rule is more of a guideline, and I need to emphasize that because it just doesn't happen all the time, and enough times to where I don't like to call it a rule. I like to call it more of a guideline. All right, the first rule is that wave 2 should not break below the beginning of wave 1. Like I said, I'm going to go through these each individually in a little bit more detail. Rule number two is that wave 3 should not be the shortest wave amongst waves 1, 3, and 5. Now, the key there is that a lot of times people assume that the rule is that wave 3 is the longest wave. And I will tell you that most of the time, wave 3 is the longest wave, and it's okay to assume that wave 3 is typically going to be the longest wave because, like I said, most of the time it is. But that's not what the rule says. The rule says it cannot be the shortest wave. So there are going to be some cases where wave 1 is going to be longer than wave 3. And that's okay as long as wave 5 is shorter than wave 3, because wave 3 can't be the shortest wave. There are going to be cases where wave 5 is going to be the longest wave, and that's okay as long as wave 1 is shorter than wave 3, so that wave 3 isn't the shortest wave. Okay. And usually, if wave 3 isn't the longest wave, the next one, it's usually wave 5 that's that's the longer one. Usually wave 1 isn't the longest wave, but there again, there are cases where you'll get a longer wave 1. And also, as part of this rule, wave 3 should extend beyond the high of wave 1. Or if you're in a downtrend, it should extend below the low of wave 1. And again, we'll look at the details of these rules here in a second. Rule number 3 is that wave 4 should not overlap or trade in the territory of wave 1. And then the last one is, like I said, more of a guideline. It's called the Rule of Alternation, and it has to do with waves 2 and wave 4. And basically, it's that wave 2 and wave 4 will have two different types. Will form two different types of ABC patterns. And so I'll go over some different types of ABC patterns and explain what that means here, and when we get to that slide. All right, first rule is that wave 2 should not. And by the way, these rules are really helpful in trade management. I use them most of the application of using these wave rules is a lot of times in trade management. A lot of times people have trouble setting stops, because you always want to set your stop at a point where you know that you're wrong. Well, if you don't know really what you're doing or what you're looking at on a chart, how do you know you're wrong? So what a lot of people do is just set stops based on how much they're willing to lose, which is fine. That's another way to go about it, but it's you're going to have a lot more confidence when you have a stop place where, hey, if it gets to this point, I know I'm wrong about this trade, and if I know I'm wrong, I want to be out of it at that point. Because you could have your stock go down for the day, and it's about ready to take off in a huge move, and you could get scared out of it just because it's down, and you're losing a little bit of money, and miss the big move it's about to make because you don't know that it's still okay. And this is a good one for trade management. And the rule is that wave 2 should not go below the beginning of wave 1. So here's our wave 1 right up here. When you get that pullback of wave 2, it can't go below the beginning of wave 1. If it does, then you're wrong. That's not a wave 2. It's something else. And by the way, anytime these rules get broken, the next step is to ask yourself, okay, then what else is going on here? What I thought was an uptrend, could it be in the downtrend? I just missed it. And so what it does is it forces you to look at the trade from a different perspective, which is hard to do. It's hard to try to force yourself on a stock you were really bullish on, to force yourself to look at it from a bearish perspective. Are there clues as to why the stock should be going down? But I tell you, there's a lot of power in doing that, because if you can recognize that not only was your analysis wrong, that stock was going up, but there's strong evidence that it's going down. Well, when you know how to make money going up and going down, you could make a lot of money trading that thing to the downside. And it could be that you're early on that downward move because you're probably seeing things that a lot of other traders out there aren't seeing yet, which is why it doesn't have a strong bearish feel to it. So sometimes you can get in ahead of those bigger moves when you can recognize some of these rules getting broken. So if I were, let's say I had a move up on the stock, it had like one of these ABC patterns like we were looking at with. Well, let's pull that up. Let's go back to let's actually pull up. I think it was AEYE. Oh no, it was Lumber Liquidators, and that big ABC or possible ABC. Okay, so let's say let's say this thing, I wait for this thing. This looks like it's completed an ABC pattern. So it should be starting a 5-wave move, 1, 2, 3, 4, 5, or something like that. Could be bigger than that. So if let's say it goes up and goes to a buy signal, you could put a stop below here because you know this rule. If this is wave 1 starting a new move up and this thing has a pullback and it comes too deep right here and it drops below this low right here, then you know that that wasn't a wave 1. This wasn't a wave 2. And you could start to look at alternatives. What else could be going on here? And these wave rules, I forgot to point out too, these wave rules are the same for every, remember last week we talked about the different wave degrees, the waves within waves, so to speak. Well, each of these rules apply to each of those wave counts, which means that that this wave 2 right here, the smaller wave 1, and this wave 2 can't go below the beginning of wave 1. This larger wave 1 right here, this wave 2 can't go below the beginning of that wave 1. And you can be in a downtrend too. So this way, here's a wave 1 going down, forming that larger wave A right there. Well, this wave 2 can't go below or above the beginning of wave 1. Now, why is that important with even what we're looking at here with the market? Well, let's look at the SPY chart. The reason why I'm kind of so focused on this breakout area right here is because we had that sell-off last week right there. I didn't know if this was starting a bigger correction, whether that's wave A, we were going to get wave B and then wave C, or if this is just wave 1 starting a bigger correction down. Well, if it was a wave 1 starting a bigger correction down, I know that wave 2 can't go above the beginning of wave 1. So if we break out above this area right here, that can't be a wave 1. And it's unlikely to be a wave A. And so that means that this uptrend is continuing. It means that bearish outlook was likely wrong. And so that's why I have a lot of confidence right here if we break out that we're going to go higher. Okay. Now, again, anything can happen. You can have something that really freaks the market out that throws that off. But and that's why you can have exceptions to some of these sometimes. But usually that would be pretty rare. And so the likelihood is if we break out that we're most likely going higher. All right, second rule, wave 3 should not be the shortest of waves 1, 3, and 5. So this would be a proper labeling right here. Your wave 1, wave 2, wave 3, wave 4, wave 5. Wave 3 is not, in this case, wave 3 is longer than both wave 1 and wave 5. But this is where that rule can be important. Let's say you're looking at your wave, you're looking at a chart, you say, okay, oh, I see it right here. Here's wave 1, here's wave 2, here's wave 3, wave 4, wave 5. Well, that would be an improper labeling because actually this breaks 2 rules. It breaks rule number 3 as well. But in this case, wave 3 is clearly the shortest wave. And as we mentioned a little bit earlier, that what the rule number 3 is that wave 4 should not trade in the territory of wave 1, which it did right there. So that would break 2 of the 3 main rules. So obviously that's wrong. That would be a wrong labeling. Now, again, if you have a wrong labeling or it breaks a rule, you ask yourself, well, what else could it be? Well, it's probably this is the correction right here. This is probably an ABC correction right here. Look how it's more sideways. So that could be a wave 1, and this whole correction right here could be wave 2, And this is probably wave 3, and you'd be expecting wave 4 and then wave 5. Or, we'll talk about this in a second, you could be looking at what we call extended waves. What are extended waves? Well, very often, let me go to the next slide here. Very often, because wave 3 is usually the longest wave, very often within that longest wave, whichever one is the longest wave, very often you can see a mini 5-wave move within that. And we call this an extended wave. So the most popular is a 3rd wave extension where wave 3 is the longest wave. And what will happen is you'll see wave 1, wave 2, and then here's wave 3. But within that long move, you'll see 5 waves, 1, 2, 3, 4, 5. And usually I'll label those extended waves with the lowercase Roman numeral, so I can kind of tell the difference. Sorry, it's hard to kind of draw with this thing. And then you get wave 4, and then you get wave 5. Now, if you're not, if the 5th wave is extended, that's also the second most common, because I said usually if wave 3 isn't longest wave, then wave 5 is usually the longest. And this can be kind of tough because you get your wave 1, wave 2, wave 3, wave 4. It looks like you get wave 5. It looks like you're done, and you're waiting for that pullback, and that ends up being just wave 1 of 5, 2 of 5, 3 of 5, 4 of 5, 5 of 5. In other words, it keeps kind of extending on. This can happen sometimes when you get into a stock that kind of gets into kind of a mania situation where everyone just starts piling in. By the time you get to wave 5, everyone's aware that stock's in an uptrend, and sometimes people are getting more and more bullish on that stock, and then sometimes it can create you can get a stock that's already overbought because of the run it's had, but it goes even more overbought because of that mania that kind of kicks in, and so that's usually what creates a 5th wave extension. First wave extensions are very rare because usually wave 1's not the longest wave, but there can be situations where that happens. Now the good news is you don't always have to always be able to know which is the extended wave. Is wave 1 the extended wave? Is wave 3? Is wave 5? If you happen to see 9 waves within a trend, you'll know that, hey, there's an extended wave in there. So if you see 9 waves, that means there was an extended wave in there somewhere. Usually, like I said, it's going to be in that wave 3, but it doesn't really matter where it's at. It's at that point when you're observing it, usually it's in there somewhere. It's one of those 3. So this goes back to when I was talking about it last week when I was introducing the waves. I said that each impulsive wave will have at least 5 waves to it. And that's why we say at least 5 waves, because it could have more than 5 waves, and usually it'll be either 5 or 9. And because of that extended wave. And this is just showing that it can happen in downward moves too. You could have 5 waves down and get that extended wave in wave 3. Now, why is this important to understand as well? Well, let's go back to I already took that chart off. Let's put it back up, pull it back up again. Let's pull up lumber liquidators again. Well, let's say this is wave 1 right here. And let's say you get a little bit of a pullback, and a little bit of ABC, or let's say it moves a little bit sideways here. Well, if this is wave 1 of the new move up, and this is wave 2, what's typically the longest wave? It's typically wave 3. That's the wave I want to trade. I want to trade wave 3s as often as I can. Now, wave 5s are the easiest to trade. Why? Well, because in a wave 5, here's your ABC correction. You get wave 1, wave 2, wave 3, wave 4. Wave 5s are the easiest because you can already tell you're in an uptrend. People are already bullish. People are already expecting that stock to go higher. You already have the momentum behind you. Wave 3s are a little bit harder because you haven't started the big move yet. And that's why it's usually the biggest move. But that's the one you really want to trade that really kind of takes off. Let me go to a stock that we pulled up. I've pulled this up a few times. I still like it. So you might want to keep an eye on this one. But Zoom Video. Now, why do I like Zoom Video right here? Well, as I pointed out, I can't remember if it was on Tuesday or last Thursday when I brought this one up, but here you have this nice long uptrend right here. This looks like wave A of a big correction on Zoom Video. This looks like wave B, and this looks like wave C. It went back to a sell signal and everything. Now it looks like it's starting to take off again. This looks like wave 1. This sideways move looks like wave 2. And if that's correct, Zoom should be going into wave 3, which typically is the longest wave. And so that's the wave you want to trade. Now, next week, we're going to get into wave characteristics. And one of the wave characteristics is that the reason why it's so hard to get into these trends before they take off is because it doesn't feel like it's going to take off. It doesn't feel bullish yet. I mean, it's real easy to focus on, hey, this thing is just at a sell signal. Look at it, sell signal, went to a hold, sell signal. This looks like a downtrend right here, lower highs, lower lows. But that's what I also like is that this kind of looks like an impulsive move up. This looks corrective. This looks like it could be a higher low, which means now you could break out and have a higher high right here. But it just doesn't feel bullish yet. But how many of you done that? How many of you have said, you look at a trend of a stock and you're like, man, why can't I get into? Why can't I bought Tesla down there at $10 or whatever? Well, because there's too much uncertainty down there. It doesn't feel bullish. You don't have the hype until you get up here. This is where it feels like it's safe to get in. This is where it feels like you're on the right side of the trade. And so if you want to get into the beginning of some of these big runs, you've got to be comfortable feeling uncomfortable. You got to be comfortable not seeing, not having everyone love the stock or be bullish on the stock. You got to be comfortable with having your friends say, "Oh, you're into that? I don't like that stock. That stock's been dropping for several weeks." But that's how you get in to those bigger moves. Very rarely do you ever have huge bullish sentiment on a stock right at the bottom. It just doesn't happen. But there again, if this is wave 1, I can put a stop down below here. Why? Because if this thing comes back down and goes below that low, then it breaks a rule. This is not wave 2, which means I'm not going to go into wave 3. And it probably just means that this correction isn't done yet. You have to kind of wait for the next burst of a move and pull back, and maybe that's wave 1, wave 2, and you can position yourself for wave 3. All right. Now, some other different, I'm going to not spend too much time on this because it's probably already kind of an overload, but I'll at least get in the recording so you can review it later. Sometimes wave 5s will be really short. Wave 5s don't have to always go above wave 3. In fact, we can call this a kind of a double top formation. Have you ever seen a double top formation? Not always, but sometimes it could be what we call a truncated or shortened fifth wave, where wave 5 just wasn't strong enough to break out above wave 3, and it kind of rolled over and dropped. Now, There are cases where wave 5 can go a little bit above the top of wave 3. Sometimes you'll see a stock break out, but it immediately rolls over and drops. It's kind of a false breakout. That can happen on a truncated or shortened fifth wave. A lot of times short and fifth waves happen when you get a deeper pullback of wave 4, where wave 4 pulls all the way back to you get a real big wave 3, and then wave 4 comes all the way back to the end of wave 1. Remember, wave 4 can't trade below the top of wave 1 there, or trade in the territory of wave 1. But it gets close to that, and then it tries to rally back up, but just doesn't have the energy to break out higher. That's usually what's going on there. It's just that short and fifth wave. You can also get what we call a diagonal fifth wave, or a diagonal triangle. Now, this is if you're familiar with chart patterns, this is also what's kind of referred to as a rising wedge, which tends to be a bearish formation. When you've had some nice trending moves, and then you get towards the end of the trend and it gets real choppy and back and forth, that's usually kind of bearish. Now, usually what you'll do is you'll draw a trend line along that choppiness and wait for it to break that trend line. But that's usually not a very bullish sign when it starts chopping back and forth. But it's not. Now, notice how this is not chopping sideways back and forth. It's still going higher. It's still reaching higher highs and higher lows. So it's not like some of these charts that we're looking at where we're getting this move right here. That's a bullish move right there, because that's a consolidation, and when it breaks out, it should go higher. This is going higher, but it's having weaker highs, and it's getting sluggish, and we call that a diagonal triangle. Now, key to understand in a diagonal fifth wave is that this is one of the rare cases where your rules will get broken, meaning that wave 3 could be the shortest wave, and wave 4 almost always trades in the territory of wave 1 in those diagonal moves. But just realize that's going to probably be the behavior is usually signaling the end of that particular move. Now, again, it's not saying that things are going to fall apart. It just means it's probably close to going into that ABC correction, and then maybe it starts taking off again. But I think this is a good thing to know. Just looking at a chart. If you see a stock you've been following that's been in a nice uptrend, and then it's going higher, but it's just kind of barely going higher, usually that's a sign that, and especially if you're seeing lower volume along with that, so you're reaching higher highs, but your volume is dropping, that's just it's very bearish behavior, and you're probably getting pretty close to getting a decent pullback. All right, the third rule is that wave 4 should not overlap or trade in the territory of wave 1. So again, if that's wave 1, you're saying this is wave 2, this is wave 3, this is wave 4. Nope, that can't be wave 4. Wave 4 can't trade in the territory of wave 1. Now, how could that be helpful? Well, let's say that you have your wave 1 and you had your wave 2 right here, and you got into the trade thinking that you're in wave 3. You put your stop below the beginning of wave 1 because wave 2 can't go below the beginning of wave 1. Now the stock breaks out, but you want to move your stop up, right? You want to kind of use a trailing stop. Where could you put it? Well, you could put it right below the end of wave 1, because if this thing came all the way back down and stopped you out, you're probably not in wave 4, which means you're probably not going to get wave 5. You might be coming all the way back down, and you're able to at least lock in some of those gains that you made. So that could be helpful in your trade management decisions, knowing that. And usually, what happens is if you do get what you think is wave 4. So let's say I have this big downtrend right here. I think it's done. I think that's wave 1, wave 2, wave 3. But this thing broke down below here. Remember, whenever you break a rule, you want to ask yourself, what else could it be? Well, what could be going on right there is your downtrend isn't done yet. It could be that this move up right here was wave A of a bearish correction. That was wave B. That was wave C, correcting that move down, and that you're starting another move, bigger move down. So I might have gotten stopped out of my trade. I didn't make a whole ton. In fact, if I got in right there, I kind of broke even, barely broke even there. But now, because I asked what else could it be, it looks like this is a bearish correction. We're in a big down move right here. I could buy some put options or short the stock, and maybe I can profit on it going down because I could recognize that rule getting broken. Okay. Now, I know some of your heads are spinning and you're saying, well, I would never be able to recognize that. I'm just barely learning this. Well, yeah, over time, when you get these rules down and you're seeing them on the charts and you're seeing the way that those charts behave. But this also what leads me to sometimes get those gut feelings, maybe I don't recognize right away that it's trading in the territory of wave one, but it just doesn't look right to me. It looks like I can't pinpoint why it doesn't look right. But that's, if I spend more time trying to figure out why it doesn't work out, that's usually what happens. I'm like, oh yeah, that's an Elliott wave rule broke, because these things become so ingrained in you that they become instinctive. And that's put in all that work, and that's what you get to eventually. Is that a lot of this just becomes instinctive, and it's just like anything you do. The more hours you put in, the more that those things become instinctive to you. All right. The last rule, like I said, is more of what we call a guideline instead of a rule. It's the rule of alternation. And this basically says that wave 2 and wave 4 should unfold in two different waveforms. Now, this is one that, again, you don't have to, if this gets really confusing for you, you don't have to put too much emphasis on this, but there's basically three types of ABC patterns. One is a zigzag, one is a flat ABC, and one's an irregular ABC. Let me go back a slide here where I can draw. A zigzag ABC is the one that I keep kind of using all the time, where you get a move down here, you get a partial rally, and then you get a move lower right here. It looks like a zigzag. That's usually the more common type of ABC pattern. The next most common is what we call a flat ABC. And it's basically what the name implies. It's more sideways. So you get wave A, wave B comes back to the beginning of wave A, wave C ends at the end of wave A, and it looks more sideways. That's a flat ABC. Now, in a flat ABC, if, like I said, wave B will come all the way back to the beginning of wave A. If that happens, then wave C will usually almost always terminate at the end of wave A right here. So you have a pretty good idea of where that thing's going to pull back to before taking off again. The last one is rare, and that's a good thing because these are hard to kind of see. They don't happen very often, but it's what we call an irregular ABC pattern, and that's where you get wave A. In fact, let me label these so you're trying to see which is wave A and wave B and wave C. You can see that a little bit better. So you get wave A coming down, and then wave B actually goes a little bit beyond the beginning of wave A. And then you get wave C, and wave C can sometimes will stop short of the end of wave A, or sometimes it'll exceed it. So sometimes you'll get wave A, wave B, wave C, and then it'll take off again. The reason why these are tricky is because when you start breaking out, usually, I do this all the time, usually I'm assuming that was the correction, because sometimes you can get those one move down corrections. We've seen it happen on a lot of the charts we've looked at before. Usually you'll get more than that. It'll be a little more choppy, but sometimes you'll get a one retracement move and then it takes off again. And then as it's breaking out, you're assuming, hey, this is taking off again. You buy that breakout, and then suddenly it rolls back over and comes back down again in wave C. Either of these two moves, and you get shaken out of the trade. So that's the good news, that these are rare, is because because they're rare. Usually when it's breaking out, I'm not assuming this is going to be in a regular ABC. I'm assuming this is a true breakout. It's going to run, and I'll trade it. Okay. So what the rule of alternation is saying, though, is that wave 2 and wave 4 should form two different types of ABC patterns. And typically, most of the time, wave 2 is going to be that zigzag ABC, and wave 4 is going to be the flat ABC. I'm just going to label these here, and I'll label the wave counts too. Okay. Now, I don't put a huge emphasis on. That's why I call it more of a guideline, because I tell you, there's already so many things you're trying to remember and analyze. And these stocks, when you're looking at actual stocks, they don't always, follow them perfectly. And so, I would never want you to say, you see it looks like you have a wave 4 and you want to trade a wave 5. And you say, oh, I'm not going to trade this because they're both zigzag ABCs. They're supposed to alternate. I don't know anybody, especially even any Elliott wave technicians, that would pass on that trade simply because the wave 4 didn't have a different corrective look than wave 2. But those are part of the rules, so I always include them, but then I always try to make sure I de-emphasize this last one so that we don't get too fanatical with this where we never find any trades at all. Now, let me pull up here before I wrap things up. Let's go back and look at one of the charts that we were looking at last week, or earlier this week. Let's go to a 1-year chart. We can see this a little bit better. All right, so I was looking at this little move. Here you have the long consolidation. So I was looking at this was wave 1 up here where it spiked up right there. This is wave 2. Now, again, when this thing started to spike, did this go lower than that? No. So it's wave 2 didn't go below the beginning of wave 1. I then said this looks like wave 3. This looks like wave 4. And it looks like wave 5. Okay, would rule number 2 work? Well, if that is the wave count, wave 3 isn't the shortest wave. Now, wave 5 could end up being longer than wave 3, but we already see that wave 1, if this is wave 1, it was not bigger than wave 3. So it would fit that rule. Wave 4, does wave 4 trade in the territory of wave 1? let me take the volume bars off so you can see where that top is. There's the top of wave 1 right there. Nope. So this could be a proper labeling. Again, I don't know for sure. You're never going to know for sure if this is until you're looking back. In fact, that's another thing to point out. The Elliott wave's always clear in hindsight. It's really easy to look back and say, oh yeah, that was wave 1, 2, 3, 4, 5. Obviously the tough part isn't trying to use it for what you're currently trying to trade, but that's why it's still no substitute for trade management, money management. Now, I also point out, look like there were 5 waves within this wave 3. Sometimes in your biggest wave, you'll get an extended wave, right? And so this looks like wave 1 of 3. This looks like wave 2 of 3. This looks like wave 3 of 3. And this looks like wave 4 of 3. And this looks like wave 5 of 3. Now remember, these waves within waves have to follow the rules as well. There's wave 2, go below the beginning of that wave 1. Nope. There's wave 4, overlapping or trading the territory of wave 1. No, actually, I skipped the rule. Wave 3 is not the shortest wave. In fact, wave 3 is the longest wave of those subwaves there. That wave 3 of 3 is the longest wave within that wave 3. Wave 4 doesn't trade in the territory of wave 1, so that meets that guideline. But see, this is also where you come back to, well, I don't know, this pullback right here looks a lot different than this wave 4 pullback. This is more of that zigzag ABC. So you've got a little bit of an alternation there. Maybe same here, where this is a little bit more of your zigzag ABC right here, where this is a little bit more of just a drop, where it then started to move back up again. Now it looks like if we are in wave 5 up here, that this could be wave 1 of 5, 2 of 5, 3 of 5, 4 of 5, and we could be in wave 5 of 5. But remember, there could be 9 waves, so this could be maybe wave. This is you got an extended wave in here somewhere, and maybe you see wave 5, 6, 7, 8, 9. Bottom line, though, is that it looks like we're in the later stages of this trend on Jumia. We could be getting a little bit of a larger ABC correction here pretty soon. So again, knowing that, can I still trade Jumia to the upside? Yeah, but I might just do a real quick trade, like a 1 or 2 day trade if I see something I like. It looks like it could go higher, but I wouldn't want to be, expecting a 20 or 30 point move this late in the trend there without at least getting a bigger correction before that. All right, so you're able to see a little bit of the application. I went way over time, sorry. Have a great weekend, and we'll see you Tuesday for the market update, and the training on Tuesday is going to be on with the wave characteristics, and this is going to be a fascinating class. If you like to understand market psychology, this is going to be a fun little class on Tuesday. All right, thanks everyone. Have a good week. Bye.